Have you ever looked at a company and thought, wow, this business is amazing, but then you look at the stock price and it's just not a good buy? Well, that's exactly what we're digging into today. We're going to take a deep dive into the paint giant Sherwin-Williams, all through the eyes of a long-term value investor. We'll look at the incredible business they've built, the surprising numbers, and the one big reason you might want to pump the brakes before buying the stock.
You know what? Let's just cut right to the chase. The final verdict on Sherwin-Williams? It's an excellent company. Wait for a better price. And that, right there, is the central puzzle we're going to solve today. What does it even mean when a fantastic, top-tier business is trading at a not-so-fantastic price? Let's unpack it.
So, first things first. To really get why this is such a dilemma, we have to understand just how good of a business we're talking about. What is it exactly that makes Sherwin-Williams this premium powerhouse in the first place?
Well, at its core, the business model is almost elegantly simple, and that's where its power comes from. See, Sherwin-Williams doesn't just make paint, they control the entire journey. They manufacture their own premium products, and then they sell them directly to customers through thousands of their very own stores. This is a classic example of what's called vertical integration, and honestly, it's their secret weapon.
In this setup, this vertical integration, it creates this incredibly powerful feedback loop. Think about it. By controlling manufacturing, they ensure the quality is always top-notch. By owning the stores, they control the entire customer experience. But here's the most important part. This direct line lets them build these unbelievably strong, almost sticky relationships with their number one customer, the professional contractors who are in there buying paint day in and day out.
All of that together builds what investors call a moat, basically a powerful defense that keeps competitors at bay. You can picture it like a castle, right? For Sherwin-Williams, the walls of that castle are built from four key things: a brand that people know and trust, a huge network of stores that's almost impossible for anyone else to copy, the absolute loyalty of professional painters, and just its sheer size, which lets them buy raw materials way cheaper than their rivals.
Okay, so the story sounds great, right? It's a fantastic narrative. But do the numbers actually back it up? Let's get into it and see if this quality business really shows up on the financial statements.
And wow, just look at this number. An average return on invested capital of over 16% for the last 5 years. That is absolutely fantastic. In simple terms, this number tells you how good the company is at turning every dollar it invests back into pure profit. A sustained ROIC this high isn't just a number. It's the financial proof of that powerful moat we were just talking about. It's the sign of a real economic engine.
And that amazing efficiency, well, it translates into some seriously impressive figures across the board. I mean, we're talking about a company pulling in over $23 billion in revenue. But the real story here is how profitable it is. It's consistently turning all that revenue into over $2.5 billion in net income and a very, very healthy $2.4 billion in free cash flow. This company isn't just selling paint. It's an absolute cash-generating machine.
But, no company is perfect. While the profit side of the story is incredible, this analysis does point out a few potential cracks in the foundation. The company is carrying a pretty significant amount of debt, and its ability to cover short-term bills, what's measured by the current ratio, isn't quite as strong as you might like to see. Now, these aren't necessarily deal breakers, but they are risks you have to be aware of, and they actually set the stage perfectly for the other side of our story.
And this, right here, brings us to the absolute heart of the matter. We've established it's a great business. No one's arguing that. But a great business bought at the wrong price can turn into a not-so-great investment. So let's get down to it. What is this stock actually worth?
All right, so according to this analysis, when you strip everything away, all the market noise, and you calculate the company's intrinsic value, what it's fundamentally worth based on the cash it's expected to generate, you land at a price of about $268 per share. But here's the catch. The stock was recently trading at $354. That means it's priced at a 32% premium. You're being asked to pay way, way more than what the business itself is estimated to be worth.
Now, here's another tool the analysis uses to double-check the valuation. You can see the standard PE ratio is already pretty high, at almost 35. But what happens when you factor in the company's growth and its dividend? You get something called the PG ratio. And the number here is 5.83. Let me break down why that number is so important.
The PEG ratio is a fantastic little tool because it doesn't just look at the price in a vacuum. It actually compares the price you're paying to the company's growth rate and the dividend you get back. Now, for most value investors, a PEG ratio over 1 is kind of a warning flag that a stock might be getting expensive.
So at 5.83, well, Sherwin-Williams isn't just a little expensive. The source analysis calls it materially expensive. That's a huge red flag.
This visual really tells the story. You can see all the heavy green check marks for its incredible strengths, like its brand power and that amazing ROIC. But just look at the bottom line. That one factor, premium valuation, it carries such a heavy negative weight that it almost completely cancels out all the other good stuff. The final score is just barely positive.
So the analysis lays out 3 different possibilities for the company's value. A pessimistic bear case at $220, a more realistic base case at $268, and a super optimistic bull case where everything goes right at $315. Now, just remember, the stock is currently trading at $354. That means you're being asked to pay a price that's higher than even the most optimistic best-case scenario valuation. In investing, we call that having no margin of safety. There's no room for error.
Okay, so if the current price is way too high, then what price does make sense? Let's turn all of this analysis into a practical, actionable investment plan. Here's a really practical way to think about this. Let's say your goal is to make a 9% annual return on your investment. To hit that target over a 16-year period, this analysis suggests you'd need to buy the stock at a maximum price of $250. This turns all that abstract valuation talk into a concrete, actionable price point. And you can see, if you're willing to settle for a lower return, you could afford to pay a bit more.
And of course, how long you plan to hold the stock is just as important. To get that same 9% return, you could actually afford to pay a higher price, all the way up to $315 if you only plan on holding the stock for about 5 years. But for a true long-term investor who's going to hold on for 16 years, you really need that lower entry price of $250 to let the real magic of compounding do its thing.
So after all that, what's the one big idea you should walk away with? What's the final word on Sherwin-Williams?
It really just boils down to this. You have a two-sided coin. On one side, you've got an undeniably fantastic business with a powerful moat and excellent financial returns. But on the other side, you have a stock that is, simply put, expensive right now. At its current price, it carries a lot of valuation risk with really no margin of safety to protect you.
And that brings us right back where we started. The message from this entire deep dive is crystal clear. Sherwin-Williams is a phenomenal company that you should absolutely put on your watch list. It's the kind of business you'd love to own, but you have to have the discipline to wait for the market to give you a much more attractive price to buy in. It really all comes down to that classic investing question. Is it better to buy a wonderful company at a fair price or a fair company at a wonderful price? Sherwin-Williams is the perfect case study for that debate. But what do you think? And maybe more importantly, what companies should we break down next? Let me know what you want to see in the comments below. Thanks for tuning in.